Okay, so welcome back to the discussion on put option. So put option, it gives the buyer the right, buyer is the holder, to sell the specified underlying asset at a set strike price on or before the expiry date. The buyer needs to pay the premium. Now let us say Government of India comes up with a proposal where all the farmers, okay, so for example, farmer, now he is given a right to sell. So when you get a right to sell, it is put option hold. You become a put option holder. Okay, you don't have the obligation to sell, you have the right to sell. So basically the government has told him that you can sell potato at a price of at a price of 35 rupees. Now the farmer for this will have to pay a premium of let's say 2 rupees. And then there is an expiry date that he needs to sell before 30th of June. So here the farmer is getting a right to sell. So he becomes a put option holder, and then he needs to pay 2 rupees premium. Now let us assume on 30th June, the market price of the potato goes down to 21 rupees. The market price goes to 21. So what the farmer will do, the farmer will take his potato, which the actual worth is 21, but he will be selling it to government at 35. That is, he will take it at, though the worth is 21, he will take it and go and sell it to government at 35. Now basically he's making a net gain, that is he's selling at 35 but the worth is only 21. He's making a 14 rupees gain, for which he has paid 2 rupees as a premium. Now not necessary that only farmers should do, you also can do it. You do this when you expect the price to decline. That means you have a bearish view. Now let us assume instead of the price going to 21, what would have happened if the price had gone to 50? He would have paid 2 rupees premium, and the government would buy from him only at 35. In this scenario, already he has paid 2 rupees, but he won't go to government, he will sell it in the market. So he will be not getting any gain out of this contract. Instead he will be losing around 2 rupees. So this 35 rupees is basically called as the strike price. So you make money only when the price of the commodity or a share goes below 35. Now let us look into an actual example of a put option. So on 16th April, when I look into the Reliance share price in the market, let me take Reliance. Yeah, Reliance share price in the market. I somewhere get a feeling that this share price may come down in next couple of days. That is, it may, if it breaks the current the previous support, it is above the previous support, which is now acting like, which was acting like a resistance. Assuming the Reliance comes down below the current support, like the previous, this was the previous support, then it would have acted like a resistance. Now this still can be considered as a support. So now assuming Reliance price declines to 1900 rupees, can I make money? Can I make profits here? Yes. So what I do, I go and pay 30 rupees as a premium. So instead of farmer, now we'll take the same calculation further. So instead of farmer, you have a speculator here. He has got a right to sell. He's a put option holder. Instead of potato, the asset would be Reliance. At a price of 1100 he can sell, for which he needs to pay 30 rupees premium, which is a non-refundable amount as per the contract. And now let us assume the market price comes to 900. So the farmer can take it here at, not the farmer, sorry, the trader can take it so he can go to market, buy it at, buy it at 900, give it to the option writer, the put option writer at 1100, and he will get a gain of 200, for which he has paid 30 rupees as a premium, 170. So you do this when you expect the prices to decline sharply. So when you expect the price to go down, you do this. Now let us assume in case instead of price going to 900, what if the price had gone up? So you have the right to sell at 1100, for which you have already paid 30 rupees as a premium. Now the market price has gone to 1400. So do you have to buy it here at 1400 and give it to him at 1400? You 1100, you will incur, ideally you will end up incurring around 300 rupees loss. But remember, you have the right to sell. You have a right to sell. So you say, I won't sell you, you won't get anything out of the contract, you lose only 30 rupees. So for a 30 rupees loss, you end up making around 170 rupees premium, 170 rupees gain. So let's come back to our definition here. Put option, you paid a premium. How much did you pay? You paid 30. Has a right to exercise the exercise. He has a right to exercise, that is sell the underlying. So sell the underlying here is Reliance, and risk is limited, so your risk here will be 30, and Reliance at 1100. So return reward will be unlimited. So whatever the 30 rupees you pay will be collected by a put seller, and he has an obligation to take Reliance at 1100 even if the market rate comes down to 900. Let us assume, if what if the market rate comes to 1100, you paid 30, and assume the market comes to 600. So in this scenario, you end up making a gain of 500, and you already paid 30, so your net gain will be 470. Now this 470 what you are collecting, this is the loss of the put option seller. So let's look into one example here. Assuming Axis Bank put option of 450 is trading at a premium of 14 rupees and lot size is 500, and let us assume the closing price of Axis Bank may be around 385. So in this scenario you get to, okay, so here you take the shares from the market at 385 and you can go and sell him at 450. That will result in a gain of 65 rupees for you minus 14 which you have already paid. So that way you will have a net gain of 14 51 rupees. So if the price from 450 comes to 385, you can buy at 385, give it to him at 450, so you get a 65 rupees gain. Already you paid 14, so your gain would now, profit would now be 51. Now let us assume, what if the share price goes to 600? In this scenario you will not exercise your right, you are going to ignore your rights. That is basically, you say I have already paid 14 rupees, so I won't be interested in taking the share, so your loss will be only 14. Okay, so now let us assume, what if someone goes and writes a put option of 450, let's change it, 190 strike price, assuming a trader writes ITC put option 190 strike price. So let us check what is ITC premium currently. So option stock ITC, we go for option stock, then we have ITC 190, that's around 8 rupees 70 paise. So 8.7, and lot size, letter, what is the lot size here? ITC, it's currently 2400. So closing price on the expiry date, if the closing price of ITC is 160, then so here you become a writer means you're expecting the ITC share price not to go below 190. You're highly confident the share price will be more than 190, but for your bad luck it went to 160, so you will have to take the shares from him at 190 and then sell the same thing in the market at 160. So you'll have a 30 rupees loss, but you have collected 8 rupees 70 paise, so that will make your loss around 21 rupees 30 paise. So you end up with a loss. So when does he make money? So assuming scenario 2, on the expiry date, the closing price of ITC was 210. So obviously he will not come and sell you at 190. You have zero obligation. You have collected 8 rupees 70 paise. So your profit will be 8.70. So that would be a profit for you. So you should sell a stock when you're at a put option, when you're highly confident the share price may not go down. For example, I am highly confident that people would come and buy Reliance shares at 900 if the price sharply declines at this particular level around 900. I'll put a daily chart. Okay, so yeah, so I'm highly confident the Reliance share price may not come below 800, 900. So I'm keeping with that confidence. I give a deal to others in the market. I select Reliance. I choose 900 strike. I go for a put option. 30th April. Say people are willing to pay you 6 rupees 15 paise. So all you have to do is go sell this. Like you sell it 500 quantity at 6 rupees. So 3000 gets credited in your account. And later Reliance doesn't come below 900. So remember, Reliance, the current market rate is 1175. That means for you to incur the loss, the Reliance should come down to 900. Even if it closes, let us assume Reliance closes around 896, you're still in a profit. That is because you have collected 6 rupees, but you just have to pay 4 rupees to him. So you're still in a profit of 2. So your loss will start only when the Reliance breaks a 894 rupees. So you can submit it. But then what is the guarantee that if the share price goes down, you will go and take the shares from him? If you're a writer, the exchange will ask you to deposit around 1,09,000 as a margin for the same. So once you deposit a margin of 1,09,000, then you are entitled to sell Reliance 900 put option. Yeah, this is the Reliance put option. Like that, I'm also confident that United Breweries will not come below United Breweries Limited, UBL, will not come below 800. So I can go and sell a 800 put option, and you can see here people are willing to pay me 4 rupees for it, because this guy is also highly confident that this the person who's willing to pay me 4 rupees, he's confident it may go below 800, but I'm confident it will not go below 800. So basically I take a 4 rupees from him. So in a put option you make a deal to buy the sell this, that is basically put option will have two parties. Let's revise once again. The one party who thinks the price will decline, and then there is a put option, put option seller, who has a view that the share price may go up. His view is that the share price may go up, or it may remain at the same level. His view, from 1100 the share price may go to 1200, 1300, or it may remain at 1100, but it won't come down. That's the reason he's collecting this 930 rupees. Whatever the 30 rupees you pay, will go from your account and it gets added to the put option seller's account. So in return, he takes the risk. So let us look into the graph here. So if you buy Reliance 1100 put, you pay a premium of 30, and your view is the price will come below 1100. Assuming it comes to 900, then you would be getting this difference. Your profit here would come up to 300 300 sorry 200 minus 30. That difference would be given to you, that will be equivalent to 170. But in case if the Reliance share price goes to 1684, assuming it goes to 1684, your loss will still remain only 14. You don't have to worry about it, because you have the right. Remember, having a right is a very potential thing. That is, your losses are limited. So here, even if it goes to 1300, I don't have to worry. My loss is only 14. For a writer, you can see here, assuming he has sold a nifty 11,000 put and he has collected 60. Now the Nifty has come down to 9,000. So if the Nifty comes to 9,000, then the writer will lose around 2,000 minus 60, because he has collected 60. That is a premium what he has collected. So he has to pay 2,000 minus 60 plus 60. 1,940. So like this in the market, the call and put options are very actively traded. So any stock that you want to go and see a put option, you can go to nseindia.com. For example, I feel Infi share price will go down. So I select Infosys Limited. You can go to, I'll write the steps, www.nseindia.com. You can go to the old website, click here, go to the old website, type Infi. So current market rate is 624, and if you look at the chart, so always first look into the technical chart before you decide whether you want to go for a call or a put. You selected Infi, so you can see here how the Infi prices are behaving. So this was like a strong wall. This whole region was like a strong wall for Infi. So once it broke that, now it is trying to build a new wall, and that wall is somewhere here. So now if Infi is not able to hold on this wall, again it can come down from 600 to 520. So when the share price starts declining, let's say tomorrow it comes to 600, I start looking at buying 580 put option. So let's see how much is 580 Infi put option. Infi put 580. It's around 14 rupees. So I pay 14 rupees 75 paise. I can just click like this and submit. So I'll be getting 1,200. So let's see in Excel how it works. Infi 580 put. Now it's your choice whether you want to buy it. If you buy, you're having a bearish view. So if you want to buy this, you will have a bearish view. So you have to pay 14 rupees 75 paise. The one who is selling this, like selling a put, that means he's having a bullish. He thinks that the price will remain above 580. So he will collect this 14 rupees 75 paise from you. Okay. Now Infi comes to, let's say, Infi comes to 500. So you take the shares at 500 and give it to him at 580. So you take it at 500, you give it to him at 580. Like that way you will collect 80 rupees. So the seller will have to pay 80 because the seller, if you remember, has to take the shares from you at 580. Like he will collect at 580, and then if he sells the same in the market, he would get 500. As a result, he is losing around 80. This 80 becomes, so your gain would be this, his loss, the seller's loss would be 65.25. So it's all about predicting when the share prices will decline. Now it's the same example. Let us see what happens if the Infi share price goes to 650, 600 and 600. Then, okay, so 600, then you obviously have the right. Remember, the buyer has the right. So you say, sorry, I don't want it. So you lose only 14. He will, he will not get the delivery. He will not take the delivery since the buyer has declined his right. His right. So I have declined my right. I say sorry. I don't want to get into this business of taking 600 and giving it to at 580 for a simple reason that I will incur another 20 rupees loss. So my loss will now go to 34. Because of that, I say I'm not interested. So you lose your 14 here. He gets to give 14 rupees. So he doesn't have to take. So the seller has to take the delivery only when the buyer hands over the shares in a put option.